What is up, everybody, and welcome to the show. I'm Chris, and we are here again another week, another video. And today, our topic is going to be the ultimate orange pilling of all of you, the viewers. Okay, so I gathered a bunch of data points and a bunch of information. I did a little research here, and I wanted to compare all of the asset classes to Bitcoin, right? And I want to just talk about all those and why Bitcoin is the ultimate asset, and essentially it's non-disputable at this point. But before I want to get into that, I just want to say, if you love all this stuff, please join the school group. We could chat there, we could talk, have a good time. It'll be cool. Link is in the description. Join the school group. We'll be there. So let's get into the ultimate orange pilling here. So the first thing I wanted to go over here is the dollar problem, right? So I've said in the past, I've said in other videos that the dollar is a sinking ship, okay? Fiat is designed to lose value over time through inflation, right? So, and what I mean by value here is purchasing power, because that's what you do with the dollar is you want to save and store your economic energy, and then you use it later to buy something, right? But how are you going to do that in a system that loses purchasing power over time? So I have some data points here. So let me just go over them real quick. The US dollar has lost 96 to 97% of its purchasing power since 1913. So if we do a little bit of math, that's 100 years ago. That's 113 years ago. I mean, literally 113 years ago was the best time to own the US dollar. Hilarious, right? Okay, so then we have the government's average inflation target is 2% per year. Okay, so that already that has a half-life and has a death date on just a 2% inflation, but it's often way higher than 2%. We have real inflation, which would be like housing and prices of food and prices of energy. So way higher than 2%. So don't get that twisted, right? So then we have the M2 money supply. I'm sure if you've heard of something like this, the M2 money supply exploded massively post 2020. And I think when we hear 2020, we know why. The big C word, right? All right, so let's talk about debt. So let me ask you real quick, how much debt do you have? I'm sure you have, maybe some little thing on a credit card. Maybe you have a loan, right? Maybe you have a car payment. Maybe you have a student loan. How much debt? It's probably not too much. Might be, if you've been a little more responsible, might be able to be taken care of eventually. You know what the U.S. national debt is? 34 trillion. Trillion with a T, okay? So the more money they print, each dollar is worth less, right? And your savings are just slowly taxed away from you. Inflation and the fact that savings accounts don't even beat inflation. Like in fact, my Amex savings account, like I talked to you about in the last video, lost 0.1% interest. And like, obviously that's barely anything, but it just means that your money is getting debased more and more and more. You're just losing more and more your purchasing power. In a savings account that's supposed to be for savings? Right. Weird, huh? Well, that's the dollar for you, folks. So if you want to use a quick analogy here, you have fiat currencies like the US dollar. It's a leaky bucket. You're gonna fill the bucket, meaning your savings account, and your purchasing power in that bucket is going to drain out, and then you're going to have an empty bucket, right? It's just how it is. Whereas Bitcoin is a sealed energy container. And I say the word energy, we're going to get to that. That's the last thing on our list of comparing the best asset in the world to all the other horrible, shitty assets, okay? So holding cash is a guaranteed loss. Bitcoin is engineered scarcity. So think about that for a while, all right? So let's talk about Bitcoin returns here, performance data. Bitcoin is the best performing asset of the last 15 years. Okay. Despite it being uber volatile, that's expected. That's part of the scenario here. We talked about volatility being a feature and not a bug in the last episode I did. But let's look at some data points here. So we have this word that's going to pop up a few times. I'm going to just call it CAGR, but it really means compound annual growth rate. So if you look at the CAGR over 10 years of Bitcoin, you get 60% annually, and that's like an average. 60% annually over a 10-year period. We've all been alive these 10 years, and a lot of people aren't capitalizing on that 60% annual growth. I mean, that's absurd. Over a 10-year period, we're getting 60% annually. Okay, so let's look at the 5-year CAGR, compound annual growth rate. It's 40 to 50 over a 5-year period. I mean, come on. And then obviously, if you know anything about Bitcoin, since inception, it's had millions of percent of returns. So that's crazy, but I mean, you're going from dollars to, tens of thousands of dollars. We even broke $100,000. So yeah, so there you go. So let's look into the comparing the S&P 500 real estate and gold to Bitcoin. So you got the S&P 500, what you're getting is 8 to 10% annually. Okay, so clearly it's like 8 to 10%. It's going to beat inflation a bit, in theory. So, fine. Let's see, real estate. You get a 3 to 6% real return. So, that's all right. But when I say real return, it probably means because you're dealing with just historically property, land, is going to go up. There's certain places that are going to be way worth something forever, like Manhattan, spots in New York City. You're gonna have things like London. Just you're gonna get some real return, but again, you're just holding real estate, it's buildings, it's land. And you look at gold, 1 to 2%. I mean, who's even talking about gold? Like Peter Schiff wants you to buy gold, and he screams about gold is great and Bitcoin sucks. Look at this data. I mean, 60% over a 10-year period versus gold, 1 to 2%. I mean, come on. Like, nobody wants this. This isn't helping anybody. All right, so the point here is if you own Bitcoin, you're winning, and volatility is the price you pay for performance. So there you go. That's some comparisons right there. And then also, if you look into this, there's some bullet points I wrote down. For Bitcoin, we have the increasing demand, right? We have ETFs, institutions, and retailers, and they're all sliding right into Bitcoin because they know what's happening, right? The supply is shrinking. We have long-term hodlers, and they're not selling, including me, okay? And I recommend you to not sell either, and keep it safe in things like, cold storage wallets, like Tangem, right? So 10% off your Tangem wallet in the description. But you have the supply shrinking, long-term hodlers, they're not selling. And also you're having things like people have lost their Bitcoin. So that's increasing scarcity because they're never getting that Bitcoin back. Like that guy who had like $1 billion in a hardware wallet and he lost it in a dump or whatever. He threw it out. He was searching for years, never found it. That's gone forever. Sorry, guy, but you probably just weren't very responsible with your private keys. I don't know. So there's no CEO for Bitcoin. There's no central control, and it's just pure supply and demand economics. There's no beat in Bitcoin. All right. So let's go to here. So people say Bitcoin's going to 10 plus million. Many people have said this, including people like Michael Saylor, Jack Mallers has probably said stuff like this, Saifedean Ammous, these big names. A $10 million price point for Bitcoin is based on a global asset capture. So we're looking at these different addressable markets like gold, real estate, bonds, and stocks, and they have a certain market cap. And if Bitcoin pulls from these less efficient vehicles, this is where you get the $10 million price point. So if you look into gold, gold has a $13 trillion market cap. So, and that's with a T, 13 trillion, okay? So then we got real estate with 300 trillion, bonds 100 trillion, stocks 100 trillion. So if Bitcoin absorbs just gold, that would be a $500,000 to $1 million Bitcoin price point. Now, if Bitcoin absorbs parts of real estate, bonds, and stocks, you're talking multi-million dollar Bitcoin. So that's where the $10 million Bitcoin price point is based off of. It's global asset capture. People putting their money into, smarter investments that work better historically and just better technology. And this doesn't mean, obviously, you wouldn't have real estate and wouldn't have buildings and stuff anymore. You're going to have all that, but it's not going to be, Chinese billionaires holding buildings in New York City that have 300 apartments and only 40 of them are in use. And because they're just holding their money there, they don't want to deal with upkeep and all that. It's just a store of value in real estate, right? And pretty much money laundering too. So that's the thing. So yeah, Bitcoin's competing with gold, real estate, and bonds mainly. And then you're always gonna have stocks because it's businesses, stuff like that. But those are the main things Bitcoin is competing with. So let's go into gold versus Bitcoin right now. And let's just say Bitcoin outperforms gold in every single monetary property. It's pretty easy. Let's look at the data here. We just went over gold market cap is 13 trillion, okay? And right now the Bitcoin market cap, I believe, is at 1.3 trillion. I believe it's been higher than that, but there have been some sell-offs, stuff like that over a little while. I think it dropped under 1.4 trillion, but still, it's 1.39 trillion. Gold inflation each year is like about 1.5 to 2%. So that's, you could consider it scarce for sure, but if you compare it to Bitcoin's inflation is trending to zero because there's a cap. So we're obviously still mining, but it takes real energy to mine. It's not like we're just getting them out of thin air. And this is what people say, Bitcoin's not backed by anything, or it's not worth anything. Like, that's bullshit. It's the same thing as gold. You have to have a lot of machinery. Let's bring up the fact that you also had to create all that machinery, which took tons of energy. You have to have workers. You have to pay those workers, the whole thing. You have to fund these projects to go find the gold and dig it up out of the ground. Okay, same thing with Bitcoin. It's just digital. You have to expend real life energy in the mining protocols and the systems, and then you use that energy and you create Bitcoins. Without energy, you don't get any Bitcoin. So it's the same thing here. You need real energy. So let's look at some performance real quick for this, because we have gold on a 10-year return. You're getting 1 to 2%, like I already mentioned. That sucks. I mean, what are we doing here? Bitcoin's 60. Gold is physical, right? You got to have it in your hand. It's a bar. Somebody can steal your bar of gold or your little nuggets of gold or whatever you have in a safe somewhere. They can steal that, right? It's physical, it's slow, and it's hard to verify. Whereas Bitcoin is digital, instant, and verifiable. So I know, like, you could still, if you're holding Bitcoin, you could still lose your private keys and all that, but or your private keys could be stolen or whatever. But there's like way better ways to actually hide these things. Like, for example, you can have your private key etched into a washer, and then have that washer, screwed into the back of your dresser in your bedroom or something. It's like, who's ever gonna find that? It's like, you could have your private key. I've heard somebody, I believe it was in my Go Mining clan, they talk about they have their private key in plain sight around their house, but like, it's like nobody would be able to know, because it'd just be like word placement around your house in random places that you would never be able to figure out. I've heard many ways people do this. It's so much easier to hide private keys than hide a bar of gold or something like that, right? And keep it safe. And also, the ultimate safety behind Bitcoin would be if you just remember all the words in your head. Like, if you had a 12-digit private, or if you had a 12-word private key, you just hold. If you can remember those 12 words, you're good. Nobody can ever get it from you unless they tortured it out of you, right? So there you go. That's a little gold versus Bitcoin there. So let's go stocks versus Bitcoin. Okay, so let's go S&P average return, 8 to 10%. Now let's go into what this requires. It requires an earnings growth, it requires management execution, and it requires market conditions, right? So stocks are real businesses. So I'm not saying they're bad. I'm just saying that Bitcoin outperforms them massively. And then you look at the stock market in entirety, and you realize that most of the returns are from the Mag 7. What is the Mag 7, you may ask? Well, the Mag 7 is Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. And guess what? If you don't own those 7 stocks or some of those 7 stocks, then you lost the entire stock market, because the Mag 7 makes up like 70 or 80%, I believe, of the entire stock market. It's like, come on, like this is craziness, right? But it makes perfect sense because they're the biggest companies. But then if you think about it, like Bitcoin is the internet of assets, then you would see how just like Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla were digital transformations of the world, then you would see how Bitcoin is a digital transformation of the world, but in a way better and more efficient way, right? So let's look into the risks of what we have when we have stocks and public companies. We have possibilities of the company failing. That's a problem, because then you lose all your money just off of the whim of a horrible decision that some CEO made or something like that. You have dilution, which means having a decreased value due to an increase in the total number of shares. So obviously there are probably laws around all this, but like you could just issue more shares to your company, and then that dilutes your company, and then you lose the value in whatever you're holding. So that eliminates the purpose, right? Then you have regulation from governments. That's something we all know, where governments can regulate things. And this is why Bitcoin's brilliant, because it has no CEO, no earnings needed, no dilution, right? And then also, not to mention, as a company, you're always going to have competition. There's always going to be somebody that's trying to beat out your company. So if you have all your money and all your bets into this one company, there's always a company that's trying to beat them. And if they do succeed, then you lose your money. So it's it sucks. But it's got to happen. We got to have businesses, right? So you got to be able to do this. And I'm not saying that you shouldn't invest in the stock market, because why not? You probably should. But don't tell me that you should only have, don't tell me that Bitcoin's not better. I mean, come on. Stocks are businesses and Bitcoin is a monetary network, right? Okay. So now this one's going to be short, because it should be short, because it's bonds versus Bitcoin. And bonds suck, right? Bonds are guaranteed underperformers in inflationary systems. Bonds suck. They've always sucked, unless you were like a boomer, or yeah, maybe, unless you were like an older generation who transitioned to bonds as you got older, as a steadier portfolio. But bonds yield 2 to 5%. Guess what? Inflation yields 2 to 6%. So you're often getting negative returns from bonds. So bonds suck, right? Now let's go to real estate. Real estate is probably the strongest store of value in this little presentation here, but it's extremely inefficient. Let's get into it. So we got average returns of 3 to 6%. So really what you're getting out of owning a building is just, you're technically going to try to beat inflation or just keep up with it, really. But you're just buying land in a major city like New York. So you're buying a skyscraper, and then you're just holding all your money in there because historically the market and the price of real estate goes up. So you're just holding there. Now the downsides to this are you have maintenance. Your pipes can leak, your toilets can break, your septic tank could need fixing, whatever. ETC. You can have many, many, many problems. And if anybody owns a house or anything, you know these problems, right? Also, you're taxed. So you could be taxed literally out of owning real estate. That's a problem, right? Because I thought you were storing all your wealth there. And then also you gotta have someone to manage all this shit. Like, you're not gonna do it. You're not gonna have you're gonna have a real estate manager. Let's be real. Especially if you're owning a giant skyscraper, right? So let's look at some downsides in terms of like using it as like a store of value. It's super liquid. I mean, it's a building. You can't break a building. You can't break a corner of a building off and go buy a car with it. Like, nobody's gonna be like, oh hey, I own a building in New York. Can I buy a car? They're gonna be like, give me cash or fucking finance it. Like, you know. So clearly very liquid, and it's location dependent, right? Like, you can't try getting a building in the airport to take it with you. Not happening. It's high friction. So I'm not saying don't own a house. You got to own a house. You got to have a place to live. That's the main purpose of them. But the purpose shouldn't be that I own a building in New York City and 3/4 of it is empty and nobody lives in it because I'm just storing my value in there instead of like renting it out. It's like, so then let's look at Bitcoin. Liquid 24/7. It's peer-to-peer. Like, literally right now, I could just, from my phone or from the computer, I could send any one of you some Bitcoin. And depending on like what kind of thing we're using, it could be very quick, like a lightning network, or it could take as little as, an hour. So it's peer-to-peer. It's easy peasy, Bitcoin back and forth. There's no maintenance. There's no upkeep. It's all running. The blockchain's running right now. Like, ooh, trade, buy Bitcoin, sell. It's all happening. It's all around us. It's borderless. You can take it anywhere, right? You can take your hardware wallet, this thing, take it anywhere. Go through an airport. It's, it's my wedding ring, but it's also a cold storage wallet. Come on, it's a signing device. I could take it to Belgium right now, and it would still be the same exact amount of money in Belgium because a Bitcoin equals a Bitcoin, right? So I could take it anywhere. And also, I don't even need this technically. I could just remember my private keys. Go anywhere, import a private keys to a wallet somewhere and use them. So easy peasy. Bitcoin's clearly superior in every way. Now let's talk about money. So there are 6 key properties of money, and I'm sure some of you know this if you know about money, but we have scarcity, portability, divisibility, durability, verifiability, and sovereignty. And if we were going to go, one by one, cash, gold, stocks, real estate, and Bitcoin, just know that all of these things except Bitcoin lack in all of these things. Okay, like the best you have really is durability for gold and real estate. Because, durability, I mean, you can't fake gold, right? I mean, you can't fake a building in New York City. So there you go. I mean, it's durable. Possible downsides, like, you could have maybe a plane hit your building, right? You can have earthquakes. You can have a tsunami, whatever happens. But you could still have the land and you could still have the gold. And the gold's not changing, right? So that's really it. Because if you look into it, you got, cash isn't scarce at all. It's kind of portable. It's kind of divisible. It's not durable. It's not verifiable. And it's not sovereign. I mean, we could go down the whole line here, but it's not great. But guess what? Bitcoin has all of these. Bitcoin is very scarce. It's portable. It's very divisible. It is durable. It is verifiable. And it is completely sovereign. What are we doing here? Bitcoin crushes the key properties of money, whereas everything else doesn't. Okay? All right, so now to end this whole rant off here, I want to talk about Bitcoin is energy. Okay? Bitcoin is energy. And by the way, this is chapter 6 in my book. You can get my book right now in the description in softcover or PDF. Um, but yeah, Bitcoin converts energy into immutable digital property. What do I mean by that? Right? So mining, Bitcoin mining requires an energy input. So you need to put energy into the systems that mine Bitcoin. So you can't just mine Bitcoin without real life raw electricity from the power grids. And these power grids are being run by real people. They take real infrastructure. Obviously, you have electricity in your home. Like, you can't just be in the desert somewhere and get electricity. If that was the case, then Nikola Tesla was right, and many conspiracies on over unity is correct, and we should be able to have infinite energy. But guess what? We really don't. Or at least it's not commercially viable and available to the public. But yeah, so you have energy input into mining. You take that energy, you create Bitcoin. Bitcoin is your output. You don't have any energy, you don't have any Bitcoin. So it's the first time ever using the proof of work protocol that you're able to create value out of energy in a digital form. So it's attaching digital to real life physics and physics laws, right? So here's the core mechanism for Bitcoin mining. Bitcoin mining uses electricity to run machines, and these machines are called ASICs, and it's a computer chip, right? A very specific computer chip. ASICs mean application specific integrated circuit. What these ASICs do is they run the proof of work protocol, which was invented in 1996 by Adam Back. I believe those numbers are right. What these ASICs do is they solve cryptographic problems. What they also do is they secure the Bitcoin network. So what you have is a network secured by the global energy grid. And that is huge because you can't fake energy, you can't fake proof of work, and it's secured globally. So let's get into that a little bit. So Bitcoin uses a proof of work. You must expand real world energy to produce valid Bitcoin blocks. There's a block every 10 minutes, and there's a block reward. And it happened in 2024. The Bitcoin block reward went up, and it'll be like that for, I guess, another 2 or so years. 3.125 Bitcoin. So you're getting over 3 Bitcoin if you are able to actually break a block on your own, solo miners. And difficulty adjusts based on the total energy, which is known as the hash rate. So the key insight here would be more energy means harder to produce Bitcoin. And then less energy coming in would mean it's easier to mine Bitcoin. And that would be like the mining difficulty adjustment. And it's a balancing act between the two, right? It's a balancing act of, more energy, harder to make Bitcoin, less energy, easier to make Bitcoin. And this pretty much just evens the playing field, because then you're not able to just dump tons and tons and tons and tons of hash power on there and expect more Bitcoin. It's going to be harder to produce Bitcoin at that point. It's a balancing act. So energy is security, right? So if you think about it, energy makes Bitcoin unhackable when you're talking about like big scales. And so to attack the Bitcoin network, you would have to have 51% of the network hash rate. So this would be a ridiculous amount of energy and hardware. It would literally cost billions of dollars and infrastructure to attack the Bitcoin network. But the thing is, if you were a horrible person that wanted to try to attack the Bitcoin network and you had billions of dollars in infrastructure, this would lead to the devaluation of the asset of Bitcoin if you were to attack the network, which means it would disincentivize the attacker. So like if the attacker's goal was just being malicious, sure, you could do that and crush the Bitcoin network if you had billions and billions of dollars and infrastructure, but you wouldn't make any money. You would lose all that money. So it's like there's You just want to watch the world burn at that point. But it would literally be better for the attacker to just to take that money and invest into Bitcoin, and then it would help everybody. So, yeah, I mean, and to break Bitcoin, you'd have to literally outspend the entire global mining network. Good luck with that. That's all I'm saying. So yeah, just to wrap all this up, Bitcoin stores economic energy across time. We've talked about this. It's a battery for human effort. You put time in, you expend energy, you put that energy into Bitcoin in the form of the money you get, and then you do as you please. There are many options now. You can take loans on your Bitcoin. You can get credit lines on your Bitcoin. You can buy, equity in the stock market on things like MSTR. And so the more Bitcoin that you buy, the more Bitcoin that they buy, the more the Bitcoin network grows, the price goes up, the richer that you get over time. Energy cannot be faked, and the work must be done. Bitcoin follows the laws of physics and not politicians and not politics. So this is like the main idea of Bitcoin, right? It's grounded in physics instead of trust. So that's why Bitcoin is the ultimate asset. And that was my little presentation there that I came up with. So just trust physics, trust physics and trust mathematics. And then you trust Bitcoin. So with all that being said, I appreciate all of you watching. Again, please join the school group if you're interested in this. Check out my book, and then also 10% off your Tangem cold storage wallet in the description. Plus, you can get a Ledger wallet, whatever you're feeling. Appreciate you all. Tune in next week. I'll have another video for you next weekend. And thank you all for watching. Click that like, subscribe, and peace.